Well, welcome back to Finance Uncut. On today's episode, how to become a silver millionaire. How to become a silver millionaire. Now, we can use wealth cycles, and I'll put a link in the description below to this video that I did, where I shared how I turned $68,000 worth of silver into almost $789,000 worth of assets. So what that means is, you buy silver, silver might go up or it might not. And just it might hold its price and everything else falls. Every other asset falls against it. And then you use that silver to buy more other assets. And then over time, those other assets go up in value. And so that's wealth cycles. So, but that's not what we're going to focus on in this video. In this video, we're going to focus on how you can get leverage over the underlying metal, over silver. And we're going to cut to a clip shortly with Rick Rule discussing this in more detail. We'll then come back. I'll share some examples of how I've also done the same thing and how I'm positioned with my silver portfolio right now.
Let's assume that they don't have as many scars as me. And the consequence of that is that I have a definable competitive advantage over them. That's true. But as a speculator, you don't have to be the best. You just have to be better than the competition. The truth is that the process that I just described to you is simple enough to do, and so few people do it that your listeners, irrespective of whether they have access to my Rolodex or not, will outcompete 95% of their contemporaries simply because they show up. The analogy I give is a 68-year-old bald fat guy like me can win the 100-meter dash if I'm the only guy that shows up to run. If your listeners employ the same technique and all of their competition employs the more normal technique, which is got a hunch, bet a bunch, your listeners are going to win. I do something else, Bill, and I shouldn't let this out. On the other hand, maybe the issuers aren't listening to this broadcast. One thing I always do, if I can, is if I've reviewed the company's material before I'm interrogating the management team, I ask them a couple questions that I know the answer to, where it would seem to be in their short-term advantage to lie to me. And I see if they lie. Because if they lie, I can't trust their information. And if I don't have any information, I can't speculate. My whole game, if I'm spending a day interrogating 10 companies, is to make 9 of them go in the trash can. It's the ones that keep popping back out of the trash can, refusing to get thrown away, that you have to pay attention to. Your first job, all of your subscribers are looking for opportunity. Brian describes himself as risk averse. So the first thing that your customers need to do, your listeners need to do, is become more like Brian. Don't worry about this fear of missing out is the height of stupidity. Don't worry about missing something that goes up. That's what's called an error of omission. It's money that you didn't make. Making a mistake is an error of commission, where the money comes out of your pocket and goes to money heaven. Errors of commission are much worse than errors of omission. So your first thing to do is take 10 companies and make 9 of them go to company heaven. Then you can start doing the work. As far as I'm concerned, there are 3 broad categories of exploration speculation, maybe 4, that work. The one that's worked for the best for me is very, very boring and takes a very long time. And most speculators don't have the patience for it. That's prospect generation. We've talked a bit about prospect generation before, but for your new listeners, prospect generators are the type of company that uses their technical and commercial acumen to develop exploration theories, stake or acquire ground to test the theory on, and then farm out the heavy lifting, the exploration expenditure and the drilling, to another company for a carried interest. In other words, understanding that they are pure brain power businesses and leaving the heavy lifting to others. If you follow the thesis arithmetically that 1 in 3,000 anomalies becomes a mine, and I've heard numbers much greater than that. I've heard 1 in 10,000 actually. But if you follow the basic math that 1 in 3,000 mineralized anomalies becomes a mine, you understand that bringing in a joint venture partner to take a 1 in 3,000 risk on your behalf, rather than issuing your own shares and preserving your proportional share in the intellectual capital in the company, which is where the real value in an intellectual intellectual property business is, while boring, is statistically the single best way to play the game if you can manage your time preference, which many speculators can't. I have participated now, and to be honest, I forget the exact number, but something like 65 prospect generators in 35 years of speculating and exploration. And amazingly, in a field where the expectation of success is 1 in 3,000, I have participated now in 23 economic discoveries and 22 takeovers. So my experience has been a 33 or 34% success rate in a business where my gross expectation would have been 1 in 3,000. I think that's a 2 standard deviation improvement in expected return. You know, it's been a while since I did that kind of math. Suffice it to say, it's a pretty amazing statistic. Now, it bores the hell out of people. So many people don't want to do it. There are some prospect generators, as an example, like EMX, which I have now held for 22 years. It's worthy to note that because they don't have to dilute 3 times in that 22 years, it's had a 10-for-1 run. So there's been plenty of opportunity in the interim. Probably the technique that is more suited to most speculators is the discovery play, which is to say you have a mineralized anomaly where you have strike and you have width on surface, but you don't have the third dimension. You don't have a drill hole. And somebody sticks a drill hole in it. And that drill hole gives you an amazing piece of data. Very often on a successful drill hole, the stock will, let's say, triple. And people who don't understand that value has been created rebel at the fact that what was a $1 stock becomes a $3 stock. A good discovery is almost always substantially cheaper at $3 than it was at $1 because you have that third dimension. You have the beginnings of value. Most people prefer to play the game anticipating that drill hole, which is to say drill hole speculation. In other words, many people look at that $1 stock and say, if they hit it, this will be a $3 or $4 stock. So they buy substantially before the drill hole. This is extraordinarily risky because this subjects you to that 1 in 3,000 probability thing. What you need to understand with a good deposit, and I define a good deposit as one that has at least medium grade, but the possibility for substantial tonnage, is that the first run that you see after the initial drill hole is probably still buying knowledge at a wholesale level. I've seen several circumstances where, yes, the stock went from 50 cents or 60 cents to $1 to $2 or $3. And I felt bad about not having the courage to buy it before it ran. But good news followed good news, followed good news, followed good news. The managements kept answering successively more valuable unanswered questions. And the stock went from, say, $2 to $15 or $20. The easy money actually was made after the run-up following that initial drill hole. The third technique is a sub rosa technique. And to be honest with you, I manage too much money now to do this. I don't have the time, but it used to be absolutely a wonderful way for me to make money. It was popularized by John Kaiser as the bottom fish technique. You look for a high quality team of people or a sort of a mining house, a discovery group or somebody like that, and you look for their inactive company, the shell that they're reorganizing. It has no property in it. It has no active promotion. Nothing's going on. If you look at the price chart over the last 2 years, it has the trajectory of a brick thrown off a bridge. You know, it's declined from 45 cents to 5 cents. But you see it start to flatten out, interestingly. Nothing is going on, but the descent to zero stops. Maybe the officers and directors are loaning it some money to stay alive. This is an age-old technique where you put money into the company on a shadow basis, and you actually scare the market because they see themselves being behind your debt. And then all of a sudden, you put a property in the company, convert the debt to equity. By the way, by Canadian law, that becomes free trading equity, not restricted equity, and it's off to the races. And there is a group of Canadian speculators who does nothing but look for inactive companies that are in the control of people who know how to make stocks go up. Bottom fishing. Most people want the trifecta. They want the statistical superiority of the prospect generating business model, and they want the sex associated with a successful drill hole, and they want to buy it for a nickel. That's very much like wanting a nasty weekend with all the women from Victoria's Secret. You can want it, but you ain't going to get it. It's important, I think, that you think in terms of what you can have to guide your expectations and exploration.
Is there any particular metal or deposit or deposit type that you're particularly interested in this next, exploration cycle?
Not for me. Okay. I've made money in sand and gravel. I'm completely agnostic as to how I make money. I'm very fond of what I call tier one deposits. I think if you're going to take the risk inherent in exploration, because the risks are enormous, the potential rewards should be enormous too. Too many times I've seen guys look for small mines, and unfortunately, occasionally they succeed. Everything that can go wrong with a big mine can go wrong with a small mine, but a small mine can never make you big money. And the idea that I would take big risk for small rewards doesn't work for me. So my own definition of a tier one deposit is $10 billion or more in recoverable in situ resource. Pro forma stage, which is to say PEA stage or target stage, top decile return on capital employed, and best quartile all-in sustaining cost. That is to say, a deposit that would get the attention of a Barrick, a Newmont, a BHP, a Rio. The 500,000 ounce gold deposit is fun. It makes you feel warm and fuzzy and all that kind of thing. But taking a 1 in 3,000 chance to find a 500,000 ounce deposit is not a good juxtaposition of risk to reward. As to materials, there are materials that I think will do better in price over the next 5 years than others. But I'm much more interested in the conjunction of the technical acumen of the management team and the task at hand. If you give me a big, high-grade lead zinc deposit, I'm a happy camper. Copper works for me, tin works for me, gold works for me, silver works for me, uranium works for me. It's all good, all good.
So I recorded this video. It was one of my earlier videos, so the sound isn't the greatest, so I do apologize. But in this video, I just shared about how I value gold and silver miners and explorers, and shared some examples of some explorers that did extremely well and can multiply your portfolio. And I actually shared an example of one of my stocks, Chalice Minerals, that I bought at 17 cents and sold at $4.33 from memory. I can tell you that Chalice is almost $10 today. It's over $9. So yeah, a little bit annoying. However, I'll be honest, it's still an explorer. It's not a producer. And I found at $4.33, it was overvalued. Look, price can change. Price can go up. Price can go down. I'm a value guy. And look, good luck to Chalice. I've certainly done well and happy to take those profits. Yeah, it's always a little bit annoying to leave some profits on the table. However, let's just cut to a clip in this video where I share some two examples of how explorers can really multiply your portfolio. Saracen Minerals, now they have just merged with Northern Star. As of a couple of weeks ago, they have been delisted. However, if you bought Saracen, in June 2013, they were trading at 8 cents. So they're a small exploration company. It last traded at $4.89, I believe, before it was delisted. However, last year, during the big run in gold, it hit an all-time high of $6.75. So had you invested $10,000 in 2013, that would be $611,000 today, or by the time it delisted, or $843,000 at its peak. And obviously, I've had some experience with Chalice that went from 17 cents to over $4.30, sitting around $4.50 at the moment. Northern Star, which Saracen merged with. Northern Star in July 2010 was trading at 5 cents. Today, it's trading at $9.90 with an all-time high of $17.03 last year. So a $10,000 investment 10 years ago would be $1.98 million, say $2 million today, or $3.4 million at its peak. So this is the power of, these explorers. When you do find these explorers, they really give a punch to your portfolio. And as you can see, $10,000 investment. So if you've got $200,000, $300,000, $400,000, as your investment portfolio, putting $5,000 or $10,000 in some explorers, I don't think is too much. And I'll put a link in the description below to this video as well, how you can print money just like Buffett. One thing that I found out earlier this year, the legendary investor Doug Casey sells options, and that's what I do. It's a big core part of what I do in my private investment business. I sell out of the money covered calls on stocks that I own. I sell naked puts on stocks that I want to own, and I generally make around 2% a month premium on that. So that can be significant, cash flow each year, as well as some of my bigger stocks, my bigger gold mining stocks, and other mining stocks. Pay between a 3 and 6% fully franked dividend. So I'm making around 2% a month. Sometimes I take less if I want to go further out of the money, whatever. But about 2% I make, so 24% a year. Add on some dividends, and it's happy days for me. I'll also put a link in the description to this video I did, Wall Street Secrets. Banks don't want you to know. It's a mate of mine who's was a very successful Wall Street trader. Has taught me a thing or two, and I've used that and had tremendous success. And so once again, I'm just passing on this information, knowledge. I don't want to hold it for myself. So it's all for you guys. So this is how you in my opinion, become a millionaire, investing in silver and gold. And gold and silver is that insurance, and that physical gold and silver is insurance. And for me, it's using wealth cycles, but also investing in gold and silver miners and gold and silver explorers. That's where I really get that leverage. That's where a lot of wealth is created. And I think Rick Rule did a fantastic job in this video, and I'll put a link to that below. It goes for an hour. It is an absolute masterclass, and I just strongly recommend you watch it all. If this is your interest, gold and silver and miners, I strongly recommend you watch that, and watch my video that I did, how I value gold and silver stocks, what I look for. Very similar to Rick. I think Rick's just an absolute legend in this space. So anyway, guys, if you like this video, please hit that like button. Love to see your thoughts and opinions in the comments below. Take care, and I'll see you again on another episode of Finance Uncut.